Howdy, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Tuesday, June 17th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are two of them. Number one, is it time to buy protection? And number two, did the BOJ just cave to Japanese government bond vigilantes? Our answers: risk assets are declining today after President Trump cut short his trip to the G7 summit. Trump's early departure from the G7 means Indian Prime Minister Narendra Modi lost a key opportunity to secure a trade deal with the US. Japanese Prime Minister Shigeru Ishiba also failed to secure an agreement on a bilateral trade deal with the G7, as did Canadian Prime Minister Mark Carney. All told, we still anticipate trade negotiations will largely end well, because that outcome best serves the Trump administration that is looking to, number one, engineer an economic boom and stabilize and ultimately delever the US public sector balance sheet, and number two, accumulate wins on the economic front ahead of the 2026 midterms. As such, we continue to believe the net impact of tariffs upon the economy is still being grossly overestimated by investor consensus when factoring in the totality of our Paradigm C thesis. Regarding Paradigm C, Senate Republicans' first draft of amending the One Big Ugly Bill Act represents the first stench of congressional brinksmanship that markets will have to digest this summer. Most notably, the Senate plan imposes steeper Medicaid cuts than the House, and it raises the debt limit by $5 trillion versus the $4 trillion proposal in the House version. Another guaranteed avenue for congressional brinksmanship stems from the Senate bill retaining the $10,000 SALT deduction cap as a placeholder, sidestepping resolution on one of the most divisive tax provisions. Despite these predictable setbacks, we still view congressional brinksmanship regarding the One Big Ugly Bill as a scarecrow to be faded by every investor with a time horizon that extends past this summer. Elsewhere, the Bank of Japan held its key rate at 0.5% by unanimous vote, in line with expectations. It also announced a slower pace of JGB tapering from April 2026, signaling caution amid market volatility. In our view, this represents a dovish policy pivot in response to financial stability concerns emanating from the bond market, akin to the Trump administration's pivot from Paradigm B to Paradigm C in early April. The BOJ's decision to marginally support the JGB market comes amid a record 43% of 72 surveyed central banks planning to boost gold reserves in 12 months, per the World Gold Council and YouGov, which is up from 29% and the highest in the 8 years of their survey. All roads lead to KISS, which is risk-managed exposure to stocks, gold, and Bitcoin. The sooner investors recognize this, the better off their portfolios will be amid this deepening fourth turning poly crisis that we proactively predicted 2 years ago in the summer of 2025. Sorry, we didn't predict the fourth turning poly crisis. We helped our clients start understanding the impact of the fourth turning poly crisis upon the economy, policy, and ultimately asset markets based on an empirical deep dive that, in our opinion, was missing from our friend and one of my mentor, Neil Howe's seminal work on the subject matter. So I think we added a tremendous amount to that subject matter as it relates to helping our clients navigate this this deepening fourth turning poly crisis. So as always, we'll wrap up with a question from our community. So transitioning to our 42 Macro dashboard here. This one is titled "Appropriate for Any Age." It just reads, is KISS appropriate for any age? For example, would it be appropriate for someone 40, 50, or 60? So let me start by answering this with a brief disclaimer. Obviously, we have our disclaimer at the end of these macro minute videos, but a brief disclaimer. All of our research is general in nature. If you need help trying to ascertain whether or not this is or is not appropriate for you as an individual investor, please consult a financial advisor and don't interpret what we're saying literally. However, I will say, and we talked about this last Thursday, I believe, last Friday in the macro minute. No, it was last Thursday when we essentially answered the same question. So bear with me, and I apologize if you heard all these answers before. But again, I think it's very clearly worth repeating. I use KISS to manage 100% of my liquid net worth. I am also first generation rich, and also someone who grew up sleeping in and out of homeless shelters, in motels, occasionally in vans, and the rest of the time in housing projects. I do not want to go back to sleeping in any of those places, nor do I want my family back home to go to sleeping in any of those places, family that I'm supporting financially. So, do you think it's appropriate for me to have all of my liquid net worth invested in a strategy that has a high propensity for risk, that has a negatively skewed return distribution, that will fail to manage risks? No, of course not. So I think you can take a little bit of solace as someone in their 50s, 60s, participating in our KISS strategy, because ultimately you can trust the risk management overlays. It's not the asset classes. Well, the asset classes certainly help you position your portfolio in the proper investments from the perspective of the deepening fourth turning poly crisis that our clients are successfully navigating and have been for a couple of years now. Or rather, they've been navigating markets very well since we started the firm back in April of 2021. With regards to the fourth turning poly crisis, they've been navigating that really effectively thanks to our KISS solution that we implemented in January of 2023. So going back into KISS and comparing it to a lot of the, I guess what I think a lot of folks in their 50s and 60s are being sold by traditional financial professionals that don't have the investing acumen and the track record that we've developed already here at 42 Macro. When you look at KISS and you compare that to, let's say, the 60/40 portfolio, which I'm guessing a lot of folks in their 50s and 60s have some version of at the current juncture. If you look at KISS's average annual return, and this is data through last Friday, average annual return on this rolling out of sample back test in KISS, which begins in January of 2018, that's 24% versus only 10% for the 60/40 portfolio. Okay, so you're saying, fine, I'll accept less than half the returns, but ostensibly the 60/40 portfolio is safer than a portfolio that only features stocks, gold, and Bitcoin. Wrong. The max drawdown for the 60/40 portfolio is minus 22% in the life of this out of sample back test here, whereas the max drawdown for the KISS strategy is only 12%. So it's essentially half of the max drawdown of 60/40 portfolio. And most importantly, it's the only double-digit drawdown in this entire rolling out of sample back test. It's from COVID. Whereas the 60/40 portfolio, which is assumed to be safer, but in our opinion is very much not safer, and quite frankly, it's twice as risky from the perspective of these statistics. The 60/40 portfolio has crashed twice since the life of this out of sample back test, which begins back in January of 2018. So one final thing I'll say is if you wanted to compare KISS from an upside capture ratio perspective to downside capture ratio perspective with regards to the 60/40 portfolio that many investors assume is safer, KISS has an upside capture ratio of 247% versus a downside capture ratio of only 54% for the 60/40 portfolio. So again, you're getting almost three and a half times the amount of return versus only half of the risk. And so, in my opinion, I think it's really important for investors to be aware that you may have been sold a bill of goods by the larger financial services industry with regards to these pie chart asset allocation products that they got you all stuffed in with regards to these target date funds and these pie chart asset allocations. And the reality is the people on Wall Street that are making the most money for their clients and helping them navigate crises more safely than the pie chart asset allocation that they sell to retail investors, they're employing strategies like volatility targeting and dynamic position sizing in their portfolios, which is what KISS uses to risk manage the exposure to stocks, gold, and Bitcoin. So I would say, in summary, do you want to be long a strategy that forces you to be long assets that we think are a melting ice cube with regards to the fourth turning poly crisis? Do you want to be long a pie chart asset allocation strategy that has worse performance and worse drawdown and volatility characteristics as a strategy, as our KISS strategy? I think the answer is very clear from my perspective. And if you insist on, being overly allocated to Wall Street's pie chart asset allocations that they conjure up and sell to retail investors for a variety of reasons that don't benefit retail investors, then you can just navigate to our KISS portfolio construction FAQ here inside of our client dashboard, scroll down to the question that says, what if I want to implement the KISS portfolio, but I prefer other exposures instead of the default SPY, gold, and Bitcoin? And so you just navigate to here, read that, and you can figure out what information you can extract from our discretionary risk management overlay, which we publish 6 days a week to our clients, to implement your own customized version of KISS. Let's say, for instance, you hate Bitcoin, you want a bunch of bonds. Well, swap FBTC out with TLT or AGG and just use the information from the discretionary risk management overlay to implement your own top-down and bottom-up risk management overlays, which again are volatility targeting and dynamic position sizing, the two things that separate KISS from everything else you're seeing out there in terms of trying to help retail investors navigate this deepening forward-turning poly crisis safely from an investment perspective. So I know I went a little long today, but again, this is a very important question, very important topic, and we're very glad to educate and help bring people along for the ride, because that's something that's very important to me given my background. So wrapping up there, Darius Dale here, presenting our macro minute for Tuesday, June 17th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.